Company service provider red flags indicators. Transactions that require the use of complex and opaque legal entities and arrangements. The payment of consultancy fees to shell companies established in foreign jurisdictions or jurisdictions known to have a market information of numerous shell companies. The transfer of funds in the form of loans to individuals from trusts and non-bank shell companies. These non-traditional loans then facilitate a system of regular transfers to these corporate vehicles from the borrowing individuals in form of loan repayments. The use of TCSPs in jurisdictions that do not require TCSPs to capture, return, or submit to competent authorities information on the beneficial ownership of corporate structures formed by them. The use of legal persons and legal arrangements established in jurisdictions with weak or absent AML-CFT laws and or poor record of supervision and monitoring of TCSP. The use of legal persons or legal arrangements that operate in jurisdictions with secrecy laws. The use by prospective clients of nominee agreements to hide from the TCSP the beneficial ownership of client companies. The carrying out of multiple intercompany loan transactions and or multi-jurisdictional wire transfers that have no apparent legal or commercial purpose. Clients who require the use of pre-constituted shell companies in jurisdictions that allow their use but not require updating legal or commercial purpose. Clients who require the use of pre-constituted shell companies in jurisdictions that allow their use but do not apparent legal or commercial purpose. TCSPs that market themselves and or their jurisdictions as facilitating anonymity and disguised asset ownership. Typology: multi-jurisdictional structures of corporate entities and trusts. In many instances, a structure consisting of a series of corporate entities and trusts created in different jurisdictions is used to hide and carry out a fraud scheme. The complex structure can give the appearance of a legitimate purpose, which can then be used to easily attract investment from third parties. For the third parties that are victims of such schemes, it is almost impossible to see behind the structure of the various corporate entities to find out who is liable for their loss. By setting up such a complex multi-jurisdictional structure, the seemingly logical money flow between these entities is used to move and launder criminal money. These structures can also be convenient for diverting the money flow or hiding payments. Case 1. Mr. B set up an international structure with on- and offshore companies, as well as trust to purchase insurance companies. The insurance companies were actually bought through a trust to hide the personal involvement of B. The assets of these companies were subsequently drained and used for personal benefits. The draining of these assets was concealed by transferring the money into accounts in and out of the US via wire transfers. Immediately after the acquisition, B would transfer millions of dollars of reserve assets to a corporation he set up in the US. The funds were transferred to an offshore bank account in the name of another corporation that he controlled. Once these funds were deposited into the offshore bank account, B used them to pay his personal expenses. In this way, B laundered about $225 million over a period of 9 years. Typology: specialized financial intermediaries, professionals. The cases related to this typology highlight the fact that when there is evidence of the misuse of corporate vehicles, a specialized financial intermediary or professional has often been involved, to a greater or lesser extent, in facilitating the formation of an entity and exploiting the opportunities presented by the foreign jurisdictions to employ various arrangements that can be used for a legitimate purpose, but also can be used to help conceal true beneficial ownership. such as corporate shareholders, corporate directors, and bearers. The degree of complicity of these financial intermediaries and professionals varies widely, with some unknowingly facilitating illicit activities and others having greater knowledge of their client's illicit purpose. Case 2. Mr. C was an accountant who started his own accounting and financial services business and, in Panama, he advertised his services primarily on the internet and through mass mailing, and provided a variety of services including the following: formation of offshore entities to disguise ownership of assets, passports and dual citizenship, mostly using new nominee names, movement of cash and other assets offshore and back onshore using various methods, issuance of debit cards for the purpose anonymously, repatriating and spending offshore funds, use of correspondent bank accounts to skim profits of legitimate businesses and repatriate funds through the purchase of assets and use of debit cards, anonymous trading of securities through accounts with two major brokerage houses, false invoicing, re-invoicing schemes to support a fraudulent deduction on tax returns, false investment losses to disguise transfer of funds overseas. C was identified pursuant to Internal Revenue Service investigation of one of his clients for illegal importation and sale of goods. The targets of this investigation were using a reinvoicing scheme devised by C to illegally import these chemicals into the U.S. for sale. C assisted the targets in the reinvoicing scheme by preparing the invoices, receiving the proceeds of the scheme and hiding the proceeds in a myriad of Panamanian corporations for later use by the target. As a result of this investigation, C became a subject of investigation for the formation of illegal trusts to facilitate money laundering and other crimes. The investigation disclosed that N had about 300 to 400 active clients or investors. The investigation also disclosed that it created between 5,000 to 10,000 entities for these clients, including the layering of foreign trusts, foundations, and underlying business corporations, which were formed in offshore countries. The primary package purchased by the client was referred to as the basic offshore structure that includes a foreign corporation, a foreign trust and foundation. In 2003, C was found guilty of money laundering and other criminal violations. He was sentenced to 204 months imprisonment and fined $20.3 million and ordered to pay restitution to the Internal Revenue Services in the amount of $6.5 million. Typology: misuse of CSP. Case 3. Use of shell companies to facilitate corrupt payments. An operational business goes through TCSP with the objective of gaining control of shell company domiciled under European law, giving the appearance of being operational. The objective is to pay the shell company a compensation for fictitious consulting services. This fee is then paid by the TCSP on behalf of the shell company to a third person who in turn is responsible for bribing a public official who grants access to a public exchange to the above-mentioned operational business. This corruption can be done with or without the knowledge of the TCSP. Case 4. Criminal culpability of TCSPs based on commingling of clients' funds. A company service provider on the island state of Country A embezzled $35 million from his clients over an 11-month period. The money was sent to some international criminal network organizations in Country B. The CSP was commingling its clients' funds with its own assets. The owner of the CSP was convicted and sent to prison. Case 5. Criminal culpability of TCSPs as facilitator of money laundering. A company formation agent involved in the financial services sector was prosecuted for money laundering offenses for laundering funds on behalf of organized crime groups. He carried out a complex process of funneling criminal proceeds through a system of trust and front-end shell companies linked to complex metrics of inter-account bank transfers. As administrator of all the trusts used in the scheme, he exercised full control of the funds flowing through them. Trusts as well as front-end shell companies were used deliberately to disguise the source of the money and to provide a veil of legitimacy to the financial transactions.